We are now live, so hello and welcome to those of you joining just a few minutes early. My name is Charlotte. I'll be your Money Show host for this session. I do have our speakers in the Zoom room. We're ready to begin the Fireside chat on time at 10:40 a.m. That's Eastern Standard Time, coming up in just a few short minutes. Thank you all so much for your patience, and I hope you're enjoying the show so far.
Is JC still not here?
Not just yet. I'm keeping an eye on the participant so I can allow him in. Oh, here he comes. Hi, JC. We are live. Welcome. Hello.
Hello, hello.
How's it
We'll be
going,
getting
JC?
started in just a minute here.
Stop. Do you want me to you want me to share my screen? You want me to just drop a deck?
JC, when it's time you want to talk over charts, you can just share your screen on your end, and I let Steve know as well. It's probably easier just for you to manage that on the Zoom platform when you want to go to your screen.
Cool.
I'll throw up the charts, JC. I have a deck. If there's something you're talking about, and I got the chart, I'll throw it up, okay?
I got all the transports and do you want to show any of the any beat report or any of that stuff?
No, but I have a chart of the transports too. Looks like yours. I got a lot of stuff here.
I got mostly a transportation and small cap conversation.
I got both of those. Don't worry about it.
But do you want me to share any charts?
I think I could just do it so we don't have to flip back and forth.
You wanted here, I'm gonna Slack you the deck.
I mean, if there's a specific chart,
Just put yours at the bottom there.
what do you mean? So then you want to run charts?
Yeah.
All right, fine.
Just drop it in here.
We're gonna have different backgrounds though.
All right. Well, without further ado, everyone, let's get started. So, hello and welcome. I'm joined today by Money Show's editor-in-chief, Mike Larson, who is also joined by JC Parets and Steve Strazza. Now, it's a pleasure to have you all here today, but without further ado, I will hand things over to you, Mike. To those in the audience, be sure to put questions in the live chat box. Enjoy the session.
Great, thanks, Charlotte, and thank you everyone for joining us here. As Charlotte mentioned, we've got a great session shaping up. We're going to be talking charts, we're going to be talking technicals, talking market trends, and a little bit of methodology as well during this session. You're going to be hearing from JC Parrots, Chief Market Strategist at Trend Labs, where he oversees content and research operations. You may previously know that JC was founded All Star Charts, and he is one of the most widely followed technical analysts in the world. His research helps cover professional and retail investors, U.S. and international stocks, interest rates, commodities, and forex markets. And if you aren't signed up for his email newsletter, everybody's wrong. You need to be. So check that out. We also have Steve Strazza, Chief Market Strategist for All Star Charts. He brings a unique perspective and diverse background experience to the world of financial analysis. He actually found an affinity for financial markets during his first job out of college as a Big Four CPA auditing some of Wall Street's largest broker-dealers. He spent recent years writing as an independent analyst while working on a variety of fintech projects. And he's got his newsletter, The Daily Beat. Be sure to check that out as well. That's a nicer title, The Daily Beat. Not everybody's wrong, but hey, to each their own, right? How's everything going, guys?
Good. How are you, Mike? Happy to be here.
Good. Glad you guys could join us. Kind of set the stage here as far as your backgrounds. I know people are very familiar with your work here at Money Show. So I guess I just want to jump right in. Steve, let's start with you. What are you seeing in this market? Kind of, set the table, big picture, and then we'll dive into some charts after that.
I'm seeing a scoop and score, as we call it, for the textbooks. I mean, this is one for the ages. The speed at which we went from whatever it was, fresh 6 or 7 month lows, now back to new all-time highs, really stands out. That's a rare move. And when you see a bullish momentum surge or a thrust like that, you really want to get behind it. Just a couple weeks ago, I was looking at some of these distribution patterns. We have them on some of these early slides, JC, like 28 and 29, if you want to show them. I'm looking at these topping formations, thinking we need to protect ourselves, turn a little bearish here, at least more cautious, and then the market just flipped it and reversed it. And there's an old adage that's from failed moves come fast moves in the opposite direction. That's exactly what we've seen over the course of these past 2 or 3 weeks, right, in real time. So the bulls are back in control. 28, JC, shows it really well. We checked back to that VWAP off of last year's lows, and we just ramped straight higher from there. I think that this is about as bullish as it gets, and we are in the middle or the early stages of a new rally phase within the context of an existing bull market.
JC, I want to ask or talk about the move here. I mean, we had the Liberation Day sell-off and huge rebound last year, and a lot of people were talking about, oh, this is going to be the same thing this time around for different reasons. It didn't seem like that was the case for a while, but as Steve pointed out, obviously that's changed. What are your thoughts on the magnitude of this move? Bloomberg had one story that we swung from sort of a RSI being deeply oversold to overbought, the second fastest rate of change basically in modern history for the S&P.
Yeah, I think it comes back to the primary trend in equities has been up, not just in the United States, but around the world, right? So, we've been in the camp that this is a historic breakout, 4-year consolidation in things like the small cap Russell 2000, in things like emerging markets, the MSCI Emerging Markets Index, things like the Dow Jones Transportation Average. Just these things had not been making new all-time highs yet, like the NASDAQ or the Dow or the S&P 500. Those were still below the prior cycle highs, right? So we've been in the camp that this was going to be a monster breakout, and sure enough, it was. Now, over the last couple of months, let's call it, there was that moment where it's like, okay, is this the successful retest of that breakout? And now we can go on and this secular bull market and emerging markets and transportation and small caps, a small cap stock revolution. If that's right, they need to dig in here and buy them. And they did, right? Yeah. And they did, which is perfectly normal in the direction of the primary trend where things continue. So the fact that, you've seen sort of like the recovery and then the culprits themselves, like in technology, you had hardware stocks doing great. You had semiconductor stocks doing great. Small cap tech was up 5 weeks in a row. Mid cap tech was making all-time highs. So it was really just a mega cap tech sort of situation, and software more specifically that was like, hey, is this the canary? And now all these others are going to roll over and fall apart, or do they all have it right and they're punishing the software too much? And, based on the looks of it, it looks like it was the latter. They were really destroying those software stocks while all the others were really hanging in there really well. And, not just in the United States, but in Taiwan, for example, making new all-time highs, Korea back to new all-time highs. It's not just an American thing. And I think a lot of Americans fail to realize that this is stocks is an asset thing, not an American thing.
Yeah, I'm glad you brought up the action in software, because if we, go back pre-war, before we had all those headlines and things to worry about, it was sort of AI wrecking ball. It was first AI is going to destroy the software sector, and then for a couple of days it was AI is going to replace every insurance broker and financial stock, and then I forget there was like 2 or 3 other sectors that were getting AI hammered. What do you think happens? Let's say the war's over, it ends tomorrow, what have you. Are we going to be back in the soup where you have kind of that trend coming back, or do you think that that's yesterday's news?
When are we not at war? I mean, it's like I have been at this now for 23 years. And there's always a war, or a war that doesn't end because it's taking too long, or a new war. And then there's these other people that are doing their war, but we got to get involved. And it's like a thing. When is it not like that?
Yeah. When the missiles fly, it's time to buy.
I can't live my life making portfolio decisions around whether or not we're at war, regardless of who our president is. It doesn't matter. Like, there's always a war. When is there not? Oh, there's turmoil in the Middle East. I can't believe it.
Yeah, that's a headline that I think, or an expression I think I've heard once or twice during my career too.
I think when
I gotta focus with what I can control. What I know for a fact is there's always going to be wars and shitstorms in the Middle East. Like, that's just part of life, right? So I could worry about all that stuff, or I could worry about what's in front of us. And Strazza has been talking about the scoop and score. Software were the culprits. These were the worst names. If this was some bubble that was going to collapse, these were the ones that you want to watch as leaders to the downside for further corrective action. So if these things, the worst ones, can't even go down, how bad can things be?
So let's talk about not just software, but tech overall. I mean, we had, again, 4, 5, 6 months ago, we started to see that big tech part of the market lag. You had some of these other sectors pick up the slack. It's not like the whole market rolled over or anything. What are your thoughts here? I mean, we've seen tech power back big time, and as you're showing now, semiconductors being at the leaders. What does that say about this market?
JC doesn't like it when I say this, but big tech tends to lead off the lows, right? And we're seeing that again in a real way, just over the course of the last 2 or 3 weeks here with a bang, right? The momentum is there. We have charts here, JC. Throw up.
This is just a classic. I mean, this is what the S&P 500 looks like, and you get a lot of tech here. You got your failed breakdown back below those prior cycle highs, and then there's your ripper.
And the war trade is very clearly been energy, right? So if you throw up 37 and you want to know how to navigate that whole situation, I would just use the XLE XLK ratio.
Yeah, right? Great chart.
Energy had their moment, right? Absolute incredible outperformance over the course of the first quarter. This was the only thing really working in the broader market. But if you look at the relative trend here, it's really not up off the mat, right? There's a huge level here, those 2000 lows. That XLE, XLK ratio has not been able to reclaim. So I think you want to continue to lean in favor of big tech. If you go to 38, JC, this is XLK, XLP. Yep. XLK versus the S&P 500, by the way, looks almost identical to this. Hard retest. This looks like the chart of emerging markets or some of these big bases that we have going back to the dot-com bubble, digging in. And I think that you're going to see those good old leaders reassert that leadership that we're so used to.
What does that mean for, foreign stocks? A lot of people I've talked to, looking at 2025, for example, in the first couple months of this year, you saw foreign markets outperforming U.S. on a falling dollar and so on. Do you think that trade's dead and it's going to go back to big tech and U.S. centric, or what are your thoughts on some of those overseas markets?
I think they could work together.
Okay.
Yeah, I mean, even in some of the weaker areas like UAE, India's coming back now. India got hammered on this whole technology situation, but Brazil's been hanging in there great. Look at the what is it? The 003, the CSI 300, which is the S&P 500 of China, acting pretty good there. Africa continues to act well. Latin America, like I said, Brazil. There's strength there, and then European banks just closing all-time highs. You know what I'm saying? Like, for me, like, one of the biggest tells of the market throughout my entire career is like, what are European banks doing? European banks are making all-time highs. How bad can things be? These are literally the worst, most vulnerable companies in the world. And something I think is really getting a notice is the Dow Jones Transportation Average.
Yeah.
Right? Like, I'm old school, Mike. You know that, right? I'm old school. Like, the kids these days, they don't know. This is the first index ever. You know that.
Transport, that's not AI. Wait a minute. Hold on.
Not at all.
Listen, life is not all about the AI revolution and data centers. And it's, there people are moving things. You got railroads, you got trucks, you got logistics companies. People are moving things. And if people are moving things, something's happening, right? Caterpillar's making all-time highs. You think Caterpillar's making all-time highs because no one's building anything? Yeah. Like, people are building things. Like, of course, hello, what do you think Caterpillar's making all-time highs? People are building things. Guess what? People are moving things too. Right? So you got the Dow Jones Transportation Average making all-time highs. Look at that base, right? Emerging markets looks the same way. The small cap Russell 2000 looks the same way, right? All of that looks the same. And then just look at the return since the end of October. 44% for the transports with 4% move for the industrials. Huge, huge move. So a lot of people are like, well, JC, because Avis is such a big percentage, it's really moving that. And while that might be true, look around. Look at Federal Express. New all-time highs coming out of a 7-8 year base. Kirby, new all-time highs. Madsen, all-time highs. CSX, railroads. People are moving things. All-time highs. Norfolk Southern, another railroad. All-time highs. Union Pacific looks just like the others, pushing up against new highs. What about these airlines? These airlines are horrible companies. Delta, all-time highs. United, all-time highs. Old Dominion, one of the greatest stocks of all time, has done nothing since the last cycle. Here we are, all-time highs. JB Hunt, all-time highs. Why is JB Hunt at all-time highs? Because nobody's moving anything? C.H. Robinson, all-time highs. Ryder has been a monster within the Dow Jones Transportation Average. All-time highs. Expeditors breaking out of a multi-year base. All-time highs. Even Uber, which, as we are well aware, is probably more of a software stock than it is a transport. but nevertheless, in the index, and this thing starts getting above 84. There's your squeeze. UPS stopped going down at exactly where it needed to, right at the COVID lows, and now it's moving higher. And these are the worst ones. Southwest, which doesn't look terrible. American down here. Alaska down here. And then finally, Landstar Systems stopped going down right at that former resistance, now making new 52-week highs. So, for me, I look at the Dow Jones Transportation Average making all-time highs, and I'm not like, oh, that's bearish.
I got to ask you now, this seems like a textbook example of why, narrative, not letting the narrative overwhelm you as a trader and focus on what the charts are saying, right? Because if you're talking about transports, I can't think of a sector that should be getting hammered more by higher gas prices, higher this, higher that, than transports, right? I mean, logically, that seems to make sense, but the charts are telling you something else, right?
You made fun of the everybody's wrong title of the newsletter, but that's exactly what it is, because at the end of the day, these are humans making irrational decisions, because their stress levels are elevated because there's money involved. So if I've learned anything over the last 23 years, is that at any given moment, always, everybody's wrong about something, and the sentiment is quite at an extreme. And if you could take advantage of the unwind in that sentiment, so in other words, understanding the narrative is one thing, but reality is something completely different, that's a huge arbitrage. That presents tremendous opportunity. So, if you know anything about me, you know that I'm always finding where the most vulnerable areas are. No one's paying attention to it. And, we could step on the gas, like energy coming into this year. Nobody wanted any energy. Now, all of a sudden, we're at war. Oh, JC, how'd you know there was a war coming? It's like, bro, I don't know anything about wars. I could barely point out Iran on the map. I don't know. But I did know that sentiment was like on another level, and energy was setting up for a breakout, and Strazza was buying it, I was buying it. We were all over it, right? And,
yeah.
Understanding the narrative and the vulnerability of the markets for me.
Fair enough. Steve, talk about how you trade these fast moves. I mean, tactically, what do you like to do when you see these kinds of setups? I mean, what's your favorite vehicle? What's your favorite strategy? What can people do, again, from a tactical standpoint if they see these setups?
Short-dated call options. When you see the market ramping with extreme momentum, the way it has been the last 2 or 3 weeks, I go to the usual suspects, especially coming off of market lows. I'll start at the Mag 7s, sprinkle in a little Palantir, some of the big growth stocks, right? Stocks that traditionally lead off of big market lows, and you lean into them. Nvidia, Broadcom, AMD was a good one. Apple, late bloomer, that's working now. Palantir had a nice bounce off the lows. But I just go to the largest, most liquid vehicles in the growth space, and I'll trade short-dated calls. And the amount of money you can make in these periods, increases exponentially when you do it that way.
Anything you'd add to that, JC?
In terms of how to maximize the opportunity.
Yeah, and what's the best vehicle? What's your best approach? And when, I guess I would also add, when do you know that move's starting to exhaust itself and it's maybe time to take chips off the table?
Yeah, we set price targets accordingly. We take half off the table on doubles pretty regularly. On our options and things like that. So there's ways to capture those gains along the way, but we're very disciplined in terms of our targets. Like silver, for example. When silver was ripping, I would wake up every morning and be like, dude, there's no way silver's going to keep going higher. This is crazy. But I didn't sell any silver. And then the next day it goes up, or any gold for that matter. And it's like every day, the next day it's like, dude, no, there's no way this is sustainable. Like every day I would wake up and be like, this is crazy. But I didn't do anything about it because it hadn't hit our target yet. Then it hit our target, and then it kept going for another week or two, and then it crashed, right? But there was and that's just the truth. What I think doesn't matter, because every day I was like, man, this is crazy, dude. There's no way that silver keeps going. Sure enough, right? And so you set a plan, and you stick to that plan. For me, is a great way to do it. And then some of the things Strazza was saying, for sure, these momentum thrusts that we just saw, those traditionally happen early in cycles. So you want to be really aggressive. Strazza calls it money making mode. Make hay while the sun is shining. Dance while the music's playing. There's a few times throughout the year that you get these relentless bids, and you want to be on the right side of that.
Got it. Steve, yeah, you were going to say something about when to sort of exit that trade.
I'll tell you, the cheat code is enter well. I'm a freak about my entries. I want to enter that trade as soon as it's kicking off. And what that will do is it'll make exiting a lot easier, in the sense that you get in at that optimal moment as soon as it starts moving. You wake up the next day, if you went out and traded this wave through April monthly calls or May monthly calls, right? You're up 2, 3, 4x in a couple of days, and you're taking your risk capital right back off the table. That makes exiting the trade so much easier because you free your mind from losing, right? When you book a quick profit and then hang on to, some portion for a remaining position, you let your winners run. I would not have told you if you asked me 2 weeks ago when we were back at around the neckline in the S&P 500, I would not have said we're going to be back at new all-time highs next week, right? But we are, and a lot of the positions I was in, because I entered well, I got an optimal entry, took quick profits, got my initial risk capital back. I let those winners ride, and you get surprised to the upside sometimes, and that's nice. And what you want to do is just scale out, right? Feed the ducks a little bit more every day. Pay yourself as you go, because you don't know what tomorrow's going to bring. I would not be surprised at all if we got 2 or 3 big red candles here this week. A little backing and filling, a little corrective wave. Be totally normal, right? But that's going to blow some of those short-dated calls that you're in. You're going to give a lot back. If you pay yourself as you go, and every big, up wave every day or every other day, then you're insulating yourself from that.
Got it. And just a reminder, anybody who's watching this, type those questions if you got them for JC or Steve into the chat window. They'll Charlotte will relay it to me, and we'll make sure we get your questions answered. We've got another 15 minutes or so to go in this time block. I want to ask, you brought up briefly the ratio charts, and just talk about the methodology, why those are important, how you guys use them, and what other messages you're seeing from ratio charts in this market.
I mean, listen, Strazza and I are in a market, we're in a market guys, right? And there's a lot of information that we can get from other asset classes that help inform the decisions that we're making in equities. If you're wondering whether the market environment is healthy or not, which I'm regularly wondering, you can look at the bond market, because these guys are so big, they got nowhere to hide. So if you start to see high yield junk bonds really rolling over relative to treasuries, that's not indicative of a healthy environment, but an environment where it's becoming more and more stressful out there in the bond market, which is very likely to trickle into the stock market. Also, you sort of have like the implications of risk appetite where you see, like, for example, high beta stocks outperforming low volatility stocks, right? When things are good, when market is healthy, they don't want to buy tobacco stocks and, boring canned goods and stuff like that. They want to buy semis and industrials and engineering companies and AI and like those high beta stocks that are beta just means more volatile, right? So if you have a beta, the S&P has a beta of 1. So if it's a beta of 2, it's twice as volatile as the rest of the market, right? So high beta names tend to outperform those low vol names in healthy environments. Consumer discretionary tends to outperform consumer staples, right? When things are good, investors are buying, these are home construction stocks and retailers and, internet, companies to buy things and like automobiles. Versus consumer staples, which people are going to buy, these long-only mutual funds are going to roll into the canned goods and the tobacco and the booze and the cigarettes and the condoms and the paper towels and like the things that people are going to use no matter how bad things are. So those ratios are really, really indicative. And then, I'll let Strazza chime in, but it's really just a relative strength situation. These hardware stocks were acting so well. These semiconductors were acting so well while the rest of technology, was struggling. That's relative strength. In order to quantify that, you're essentially looking at the sector or the stocks relative to the rest of the market, hence those ratio charts.
Got it. Steve?
They're great for risk appetite. They're great for intermarket analysis, like JC mentioned. But then also relative strength, just taken alone, is one of the cheat codes we have as technicians. Whereas in a sustained bull market for any asset, that asset tends to be outperforming its peers or outperforming its alternatives. So if you're wondering to yourself, is right now the time to beef up my exposure to this group or that group? Should I be adding tech here or large cap growth here? Run a ratio chart, benchmark it against the S&P 500. Is that leadership in place? Like that's a big checkbox, right? That you want to be able to check when you're making a bullish bet on something. You want to know that outperformance is there. And energy was a great example just back in Q1, right? Yeah. So you see that leadership and you just want to run with it.
Well, since we brought up credit and the issues there, I mean, obviously so much digital ink's been spilled about private credit. It's the next bubble collapse, blah, blah, blah. The big banks came out with great numbers. They don't seem to be, having too big of an issue. Thoughts on what the charts are telling? Is this a canary in a coal mine, or is this something that you can pretty much ignore unless you own BDCs?
I think for now.
What's a BDC?
the business,
development guy.
like the companies, the BDCs, the private credit related companies, the Ares of the world, and
Yeah,
so
yeah.
on. Like, I'm just wondering if you're seeing anything, like ratios, like high yield versus treasuries or so on, that suggests this credit issue is more than just a talking
That's what
point.
I would look at. I would look at those, right, Strazza?
Yeah, you don't have like any like sustained level of leadership there yet, obviously, but I will say that they look like software stocks, right? The KKRs, BXs, Owls, Carlyle groups of the world. They have little tactical bases, multi-month bases, right? The lows have probably been in for most of these stocks for a couple months now, or at least a couple weeks. And if you get like some sort of turn, that's step one of a trend reversal. When a bearish continuation pattern does not resolve to the downside, but instead it fails and resolves to the upside, that tends to be like one of those first steps that you see for a primary trend reversal. So I think you have these tactical bases intact. Something like KKR looking pretty good out here. You want to see some upside follow through, a reaction rally to the upside. And then I think we'll be looking at these groups in the future, in the coming weeks and months, and saying, oh, you have some pretty nice bases here. There's some nice reversal patterns. And they join back in the rally. I think the worst is definitely over for the BDCs, for the private equity, and then also for software, because they've really traded together since the back half of last year, software stocks and the private equity, private credit stuff.
I had to ask because we had one of our guys in the Hollywood event mention, Al's like, oh, it's time to buy. I was like, the room was quiet. You didn't hear much in the background. So,
I don't hate
oh.
that. Good for him.
Yeah. Another question for you. I got Rusty R is watching this and he chimed in asking, how do you use ADX to influence your new buys and at what level? So I'm not sure either of
I
you want
don't.
to take that. You don't.
I don't
Okay.
use that indicator. Nope.
JC, anything on
No,
ADX?
I don't even know what that is.
Okay. Well, Rusty, great question, but I guess these guys aren't.
Is that like
Look,
an
no,
ATX? Is that like an ATR situation or no?
it's a momentum indicator.
Oh.
We're RSI 14 people. We'll mix in a little PPO or MACD from the momentum side of things. Rate of change is the simplest, most basic form that you can use to analyze momentum. So those are the three that we really stick with. Chasey's a big RSI 14 guy, but we haven't put an ADX on our charts, I think, ever, to be honest.
Okay.
I know people who use it. It's like anything, Mike. You find that tool that speaks to you, that works for you. You got 10 different momentum indicators that are worthy, right? That you could build a system around or build a process around. You find that one that works for you, that you really understand, you know what to look for, and you kind of lean into it. I think we've chosen ours. But the ADX, I know plenty of great traders who do lean on that and use that as their indicator.
I guess that got me thinking a little bit about other indicators. And I'm wondering, do Bollinger Bands, anything like that factor into the way you trade as well?
Yeah.
I like my
Because
Bollinger Bands. We use
Yeah,
the Bollinger.
we like the Bollinger Band with.
Yes.
Okay. Fair
We
enough. All
used
right.
that. We actually built an indicator, a volatility compression indicator. We call it the Strazza indicator. Shout out Steve Strazza. But it's a measure of volatility compression because we know that volatility is mean reverting. So from contraction or compression comes expansion, right? So we're looking for that indicator to turn off of a very low level, like an extreme low level, and then we know a big move is coming. It tells us, however, nothing. And by the way, it's built around the Bollinger Band with John Bollinger's BBW indicator. It
Yep.
tells you nothing, however. This is where people mess this up a little bit. It tells you nothing about the direction of the move that's coming, right? You have to go and look at other things and use other data points and other supporting evidence to determine what direction that big expansion rally or down rally will come in. And then you could combine the little volatility compression indicator with some momentum indicators and really price more than anything to kind of make that bet of where that big bang is going to happen, up or down.
JC, I want to ask you, I want to say when we did one of these maybe a year ago, might not have been quite that long, you talked about sort of the commodities kind of taking over and the commodities relative, the whole commodities complex relative to equities and so on, and hard assets versus soft. And that was sort of like a big picture, a galaxy brain type observation. Does that still stand on the chart, still confirming, hey, this is, if you're looking where to be asset class wise, you still want to kind of be tilted towards commodities versus some of the other options out there?
Yeah, hard not to. For a long time, the 60/40 portfolio concept of stocks and bonds was, throughout my entire career, something I would hear about and everything like that. And whether you think that that's the right way to allocate assets or not, it's not really the point. Just kind of the way to think about it, right? So, the way I learned it was that there were three asset classes: stocks, bonds, and commodities also. Right. It's just that those for a long time, didn't get discussed because, people, our lizard brains are focused on what happened yesterday, not what's happened over the last century. Right. So for market historians, we're familiar with the more inflationary periods in the 60s and 70s, versus the deflationary environments of the 80s and the 90s and 2000s. And so, in these inflationary regimes, bonds do very poorly. But, bonds my entire career, and most people's have just seen bonds going up forever and interest rates going down, and they were like, oh, and then you hear people, my own father tells me about, how you can get CDs paying 16% in Texas and all that stuff in the early 80s. Why the hell would you want to be buying stocks? Well, actually, that was the best time to be buying stocks, as it turns out, not going out buying Texas bonds, right? You wanted to be buying stocks in the early 80s. So, understanding that sort of market history and recognizing that they don't last just for a few quarters or few years, but they last for decades, right? So to suggest that, a year ago or even today that, it's over, would argue that it's by far and away the shortest of all time, which you're welcome to make that bet if you'd like, but there's no really supporting evidence there at all. I think there's a shitstorm setting up in the bond market somewhere out there. I don't know when, but, talk about volatility compression. When you look long-term at bonds, that volatility compression that Strazza was just talking about, you're seeing it there. And there's going to be a monster category 5 hurricane coming in the bond market. To Strazza's point, I don't necessarily know the direction, but the havoc that's going to cause simply because of the rate of acceleration, because from volatility compression, as he said so eloquently just now, comes that volatility expansion. And I think that's going to happen ultimately in the bond market. But in the meantime, just kind of zoomed out, bigger picture, that 60-40 is more of like instead of stocks and bonds, is more of a stocks and commodities, is really that, that much better 60-40, with the bonds, historically acting very poorly in inflationary regimes, when it's the stocks and commodities that tend to do well. So, first goes gold, then goes copper, then goes energy. Like, you're seeing it, right?
Yeah.
That's how the cycles go. So do I think it's over? I definitely don't see anything supporting that it's over. Is it over like for now, and then other sectors take over in the stock market and things like that? Yeah, probably. But yeah, no war. I don't think that has this is a commodity super cycle before any wars. I don't know, right? Or while there were other wars, I don't even know.
This is a
Probably.
great point.
Going up there. He's ready to jump in.
No,
So
this is such an important point that he's making, because you didn't have to be a war expert or know the first thing about geopolitics or the Strait of Hormuz to be there on time or even a little bit early for the energy trade. Like JC's saying, it was two main data points. It was the intermarket. Everything else in commodities was working in sequence first. We knew energy was next just based on the history of commodity cycles. And then the volatility compression. We were looking at the volatility compression, the same thing JC just said about the bond market, one of the longest term volatility squeeze setups we've ever seen. So we're looking at that chart with that big old base in XLE saying a huge move is coming here for energy. We're thinking this in December of last year. And then we're looking at the other segments of the commodities market and saying they're all going higher. Energy's got to be next. We're going to lean long and make the bet that volatility expansion comes in the form of some big upside momentum.
We got about 5 minutes left. I'm going to keep my eye on the chat box. Again, just one last reminder, if you're watching this, go ahead and type it in. We'll get to you in the last few minutes here. But I guess I got to ask him, it sounds like a pretty bullish overall view. You're looking at commodities, you're looking at tech, you sound pretty positive, both of you, on this market. So I'm just going to ask the obvious question, which is what could go wrong? What would tell you that, hey, things are really starting to change. Maybe it is time to play defense, and, however you want to talk about playing defense. I'm just kind of curious what you'd be looking for as a short-term warning sign and maybe more of a longer-term one.
You lose those lows. Small caps stepped in where they had to, transports, emerging markets, all that stuff. Software in particular, just because they were the culprit and bounced, doesn't mean that they're still not the one to watch. If they roll over, you start seeing new lows in CRM and Adobe and DocuSign and all these stocks that got crushed. They start making Microsoft, right? Just go down the list. Oracle, you go down that list and they start rolling over, start making new lows. Then there's probably something bigger going on. Watch credit spreads starting to blow out. Look for some outperformance out of consumer staples. We've only seen the opposite. The consumer staples have been the worst sector, which if there was going to be a major correction, you'd see leadership there. Look for high beta to roll over relative to low volatility. Just close at all-time highs. Watch European banks. European banks making all-time highs is not indicative of a crash coming, right? So there's a lot of stuff.
I mean, I don't want to be a Debbie Downer, but I feel like, you got to...
I'm a Debbie Downer every day. Every day I think about what me and Strazza are here. I just bought Cardano. I bought Cardano. Like that is the worst cryptocurrency in the history of cryptocurrencies. And I just bought a whole bunch of it, and I'm probably going to buy more. Right. And so that's the environment that we're in. So if I am watching my own behavior, I have to question, am I insane? Because the market's going to crash and I'm buying Cardano, you idiot. Like I have to wonder. Because even my own friends are like, JC, don't buy Cardano. Strazza's like, what are you doing, bro? Right?
No, it's the right thing to do, though. You're moving out on the risk spectrum, right? That's what you do in times like this. If you look at the equities market right now over the past week, the best performers have been the most hated, most heavily shorted stocks, right? So in times like this, they buy the junk. They're buying the garbage. They call it the trash trade, right? So they're running all these heavily shorted
trash.
Altcoins, I think, fall into that very similar basket. And I think normally we would have a better answer for you in terms of what is that bearish evidence. But just this month, we've seen such a swing from a decent list of bearish evidence coming into the month to right now. I mean, it's really that list has gotten very small. One other thing that I would mention that JC, maybe left out was dollar index. If that surges back to and through that one key $100 level, that's going to, that's going to weigh on risk assets.
Yeah. We did have a question that popped into the chat. I want to make sure I get to it before we wrap. XY asks, do you buy silver again now? You touched briefly on silver, what it did back in January. What are your guys' thoughts on silver?
It's a mission accomplished.
Yeah.
Mission accomplished.
You're getting greedy at this point, right?
Yeah, I mean, listen, when this thing was in the teens, for gold, we're talking gold 5,000 right here. Both of us, Steve and I, gold 5,000, silver 120. I mean, that's what we were saying. Guess what? Gold went to 5,000 and silver went to 120. All right, see ya.
So it's great.
And now we just wait. Because remember, I'm in the camp that this is 1974, right? I'm not in the camp that this is 1980, 79, 80, right? So 1974, you had that correction in precious metals down to 76, and then you got the rally in the late 70s. I'm thinking that we're in that 74 to 76 period. Does it have to take that long? No. Things happen faster these days, maybe. We'll see. Maybe it does take that long. I have no idea. I got all the time in the world. I ain't going nowhere. You're stuck with me. So I'll just wait.
Got it. Steve, anything you'd add on that one?
I think there's so many opportunities in this market, right? So many things that you could do as being bullish risk assets that you don't need to press your luck in precious metals, something that's already run and really, led the market over the course of this cycle already. I think you take the profits you made there and you rotate them into some fresher areas that are just breaking out now.
Yeah. Well, for now, it doesn't mean that it's over. It's just over for now. Be patient.
Sure. Yeah,
like that 74 to 76 period, if you were sitting in that was sucked. You know what I mean? Like you needed to be in stocks during that. Stocks ripped off the 74 lows, right? So if you were sitting in rocks, that was a bummer. So I'm not trying to do that.
Well, listen, guys, this has been great. It's a lot of fun. I wish we had more time, but all good things and all that. JC, Steve, thanks so much for joining us. People watching this, thank you for your questions. We really appreciate the interactivity, and you got a whole rest of today and tomorrow on the virtual platform here. So hope you stick around, guys. Thanks again.
You got it.
Thanks, Mike.